something troubling is happening in the United States, and most people do not even notice it. Billionaires are quietly offloading their stocks, carefully, so as not to cause panic. It all started with Warren Buffett. He sold off large chunks of shares and publicly declared that the economy is in bad shape. And now, Jeff Bezos. He is not selling off random side assets, but massive portions of Amazon, his own company. Meanwhile, public statements remain calm. Polite explanations are offered to reassure the public. But let's be honest, when a founder begins to sell off his stock in large quantities, especially right after a conflict with the president, it is no longer business as usual. It is a clear warning sign that something serious is brewing. At the same time, Chinese investors are also actively pulling out of Western assets and repatriating their money back to China. This coincides with Beijing's official announcement. We will no longer rely on exports to the United States. Now the focus is on the domestic economy, and that's very bad news for Trump. If China is no longer interested in selling to the United States, what leverage does Trump have left? There's a lot to unpack here, so let's look at what's really going on. Let's start with Jeff Bezos. Last week, the Amazon founder sold nearly $740 million worth of Amazon shares. This immediately raised many questions. In the past, he also sold shares to invest in his space company Blue Origin or donate to charity. But this time, it feels different. This does not look like a routine sell-off. It feels more like a warning sign. Many believe Bezos is increasingly concerned about the state of the American economy. His actions suggest he is losing faith in the market that once made him one of the richest people in the world. And it raises a key question. What do people like him see that we do not? If you think this was a one-time sale, think again. Bezos has a plan to sell up to 25 million Amazon shares by 2026, and the timing he chose to start raises concerns. When billionaires start dumping assets during economic uncertainty, it always raises red flags. But there's more. Bezos has long been quietly at odds with Donald Trump, especially over tariffs. Recently, Trump imposed steep new tariffs on Chinese goods, some as high as 45%. And much of what Amazon sells comes from China. This means rising costs, shrinking profit margins, and growing pressure on business. Amazon even considered displaying on its website how much of each product's price comes from tariffs, a visual way to show customers how Trump's trade policy makes things more expensive. Naturally, Trump did not like that idea. Looking at the bigger picture, the American economy is unstable right now. Inflation is high. The central bank has said that Trump's tariffs are part of what's driving it. They cannot cut interest rates yet because prices are rising too fast. Big companies like Amazon are already feeling the strain, so Bezos selling his shares now is no coincidence. He is simply trying to get out before things get worse. And he is not alone. Other wealthy investors are also pulling money out of the US and moving it into more stable countries. They are losing confidence. Too much political infighting, too many surprise decisions, too much instability. That is why they are trying to exit early, while they still can. We have seen this before. When trouble starts, the wealthiest are always the first to leave, quietly, unnoticed, while everyone else is still hoping things will improve. But that is not the worst part. This is just the beginning. While uncertainty grips the United States, China is making its position very clear. President Xi Jinping recently gave a speech in which he stated plainly, China's future depends on internal resilience. He called for the creation of a unified national market, stronger domestic demand, and supply chains that can withstand external pressure. In the past, China relied primarily on exports. Now, the focus is self-sufficiency. China's message is clear. Build our own systems, shore up the domestic economy, and be ready for any scenario if the West tries to cut us off. These are not just words. Beijing is already restructuring its economy. Chaotic competition is being curbed, price wars ended, and outdated factories closed, all to create a more resilient, predictable business environment. At the same time, China is making a clever move. It wants to align global investors' interests with the needs of its home market. Firms are encouraged to sell not only abroad, but also to Chinese consumers, giving investors a built-in customer base while reducing external risks. Washington has nothing comparable right now. On 1st July, China announced a major step. Foreign investors will receive a 10% tax credit if they reinvest their profits in key sectors of the Chinese economy. Earn money in China and put it back into AI, green tech, or advance manufacturing, and you get a real tax break. Over 5 years, that benefit can be substantial. The catch? The money must stay in China for at least 5 years. Pull it out sooner and the credit vanishes. Beijing is not courting speculators. It wants serious, long-term capital and is building a financial system meant to stay stable even in rough times. Against this backdrop, US markets increasingly look like a casino. When someone as prominent as Jeff Bezos starts heading for the exits, that picture is hard to ignore. A closer look shows attitudes toward money are shifting. China's mix of firm state direction plus investor openness is starting to look safer to many. People are weary of the turmoil in the United States, where policy swings wildly and there is no clear plan. Even American economists call Trump a source of instability. His actions rattle investors who are already nervous about what comes next. But this is not only about politics, it's about returns. China offers clear rules, fewer surprises, tax incentives, and the world's largest consumer market. If you make your living from investing, that is hard to pass up. Consider the numbers. In just 5 months, China registered 24,000 new foreign-invested firms, up 10.5% from last year. These are not shell companies. Many are operational, investing, and generating real revenue. E-commerce is the standout. Foreign investment in that sector jumped 146% year-on-year. Why? China is ahead of everyone in online payments, logistics, and the use of AI in retail. Its digital economy is so well built that some investors now say the returns here are higher than in Silicon Valley. Meanwhile, conditions in the US economy are deteriorating. The World Bank has issued a stark forecast. Growth is slowing, and the drag could spread worldwide. The reason is Trump's hardline economic policies. In 2025, US GDP is expected to grow by just 1.4%. For comparison, in 2024, it was 2.8%. This sharp slowdown is tied to the new tariffs, which are hampering trade and hitting the global economy. If the United States goes ahead with another round of tariffs in July, things will only get worse. The World Bank warns that if tariffs rise by 10 percentage points, global growth in 2025 could slow to 1.8%, and in 2026 to just 2%. That would hurt business, disrupt trade, and spark market panic. The bank's chief economist, Indermit Gill, says the outlook is deteriorating. Without policy changes, living standards could drop sharply. In other words, a tariff war could lead to job losses, shrinking incomes, and weaker businesses worldwide. The problems are already spreading beyond the United States. The World Bank has downgraded its growth forecasts for Japan, India, and the Eurozone. The biggest impact will be on countries that trade heavily with the US. For example, Mexico's expected growth for 2025 has been cut to 1.5%, down from the previous forecast of 3%. Developing countries are being hit especially hard. They rely on exports of oil, raw materials, and food, but as demand and prices fall, their revenues are dropping. Gill noted that outside Asia, we are not seeing any rise in living standards. The developing world is becoming a growth-free zone. The White House claims the forecasts are exaggerated, but more and more experts agree. Trump's tariffs are genuinely harming the economy. Even the OECD recently warned that US growth could slow to 1.6%, while inflation could rise to 4%. The World Bank does concede that Trump is right about one thing. US tariff rates were previously higher than those of many countries. But analysts argue that the solution is not retaliation, but collective efforts to reduce trade barriers. That's the only way to fix the system, and the US has plenty of problems of its own. But now, even its closest allies, like the United Kingdom, South Korea, Germany, and Japan, are increasing their investments in China, and not just marginally. Investment from Japan is up 70%, from the United Kingdom, 61%. South Korea and Germany have both raised their investments by 10.7%. These countries are following the money, despite rising tensions between China and the US. That shift signals deeper changes. These nations are becoming increasingly dependent on China's economy, and over time, that affects their politics as well. They used to back the US, but now they act according to their own interests, even if that means moving closer to Beijing. The West is losing its monopoly on global influence. The economic gap between them and China is narrowing, and that's becoming most visible from within the West itself. In China, the atmosphere is completely different. While American markets are stalling due to politics and uncertainty, the Chinese market is growing. In June 2025 alone, 147 companies filed for IPOs. At the start of the year, there were fewer than 15 applications per month. Businesses are seeing opportunities and taking action. Foreign investors are increasingly turning to Chinese stock exchanges as a destination for their capital. Hong Kong has become a hub for major IPOs. In March, BYD Semiconductor raised $5.5 billion on the Shenzhen Stock Exchange. It was part of a new wave of public offerings spreading across China. Meanwhile, Wall Street is losing access to the most lucrative listings as capital flows from the West to the East. If the United States does not urgently rethink its approach, it risks losing not just investment, but its leadership in the global financial system. And once that status is gone, regaining it will be extremely difficult. To stay informed on key developments and changes in global markets, make sure to subscribe and turn on notifications. See you in the next video.